Warren Buffett just made his biggest defensive move in 58 years. He's sitting on a record $325 billion in cash, aggressively selling his favorite stocks and sending a clear warning: get out. Let me show you exactly what Buffett sees coming and, more importantly, what you need to do right now to protect your money. Let's talk about the elephant in the room: Buffett's absolutely massive cash pile. Berkshire Hathaway is currently sitting on an almost unbelievable $325 billion in cash. And this isn't just another routine financial move. To put this figure into perspective, it's larger than the GDP of many countries and exceeds the market value of corporation giants like Coca-Cola and Disney combined. Even more shocking, it's 6 times larger than what Berkshire held during the 2008 financial crisis. The big question on everyone's mind is why one of the world's most successful investors would choose to keep such an enormous amount of money on the sidelines instead of putting it to work in the market. To understand this, we need to look at Buffett's historical approach to cash management. He's always been a strong believer in maintaining a solid cash reserve, what he calls his safety net. But this isn't just about playing it safe. It's about being ready to strike when opportunities arise. We've seen this strategy play out before. During the late 90s, when everyone was caught up in the dot-com frenzy, Buffett stood firmly on the sidelines. While others rushed to pour money into overvalued tech stocks, he patiently built up his cash reserves. That decision proved brilliant when the market crashed and quality companies were suddenly available at bargain prices. The same scenario played out in 2008. While others were forced to sell at the bottom, Buffett's cash pile allowed him to make some of the most profitable investments ever, including deals with Goldman Sachs and Bank of America that would later generate billions in profits. Fast forward to today, and we're seeing Buffett employ this same strategy, but on a scale we've never seen before. His cash reserves haven't just grown, they've exploded to all-time highs. When you look at these numbers, one thing becomes crystal clear. Buffett isn't just being cautious, he's preparing for something big. The last 2 times he stockpiled cash like this, major market corrections followed. When Warren Buffett started selling Apple stock, Wall Street paid attention, and for good reason. What we're seeing now is perhaps the most shocking move in Buffett's recent investment strategy: a massive reduction in Berkshire's crown jewel holding. To truly understand how significant this is, consider that Buffett's love affair with Apple began in 2016. And since then, the investment has grown to become what he fondly called one of the 4 giants in Berkshire's portfolio. At its peak, Berkshire's stake in Apple reached an astounding $178 billion, making it the single largest investment position Buffett has ever held. But something dramatic has changed. In the last quarter alone, Buffett sold nearly 10% of his Apple position, reducing Berkshire's holding from 400 million shares to approximately 300 million. This isn't just another routine portfolio adjustment. It's a seismic shift in strategy from an investor who famously proclaimed that his favorite holding period is forever. This move is even more remarkable because Buffett has consistently praised Apple's business model and leadership, particularly CEO Tim Cook, who he's repeatedly called Apple's brilliant CEO in his shareholder letters. So what's driving this unexpected sell-off? The answer lies in true critical factors that Buffett sees in today's market. First, there's the valuation concern. Buffett has been increasingly vocal about his struggle to find reasonably priced investments in the current market environment. With Apple's stock price reaching historic highs, he's likely seeing diminishing value in maintaining such a massive position. But there's another, more subtle factor at play: taxes. Buffett has been dropping hints about the likelihood of higher capital gains taxes coming down the pipeline, especially given the current U.S. debt situation. This combination of moves, selling a beloved stock while warning about both market valuations and future tax implications, sends a powerful message to investors. When Warren Buffett starts reducing his position in what he once called one of his best investments ever, It's not just a portfolio adjustment, it's a clear warning signal about the broader market conditions he sees developing. The fact that he's willing to incur significant tax costs today by selling suggests he believes holding on could be even more costly in the future. When it comes to gauging the overall health of the market, Warren Buffett relies on one particular tool that's currently sending out alarming signals. Known as the Buffett indicator, this relatively simple metric compares the total value of the U.S. stock market to the country's GDP, essentially measuring whether the market size is reasonable relative to the actual economy that supports it. Right now, this crucial indicator isn't just flashing red, it's screaming danger at levels we've never seen before. The current reading of the Buffett indicator sits at a staggering 208%. And to understand just how extreme this is, we need to look at history. During the infamous dot-com bubble of 2000, which ended in one of the most devastating market crashes in recent history, the indicator reached what was then considered an alarming level of 140%. Even during the 2008 financial crisis, another period of significant market excess, the indicator only touched 110%. Today's reading of 208% doesn't just surpass these previous danger zones, it absolutely dwarfs them. What makes this situation particularly concerning is what this number actually tells us about the market's fundamental health. When the Buffett indicator shows that the total market value is more than double the size of the entire U.S. economy, it's signaling a severe disconnect between stock valuations and the real economic activity that ultimately must support them. Think of it like a tree with a canopy that's grown far too large for its roots to sustain. At some point, something has to give. This unprecedented reading helps explain why Buffett has been taking such dramatic defensive actions with his portfolio. He's been here before, watching these numbers climb to dangerous levels in both 2000 and 2008, and both times, his caution was validated by subsequent market crashes. But today's levels make those previous danger signals look almost quaint by comparison. When the most successful investor in history starts taking defensive actions at levels we've never seen before, it's a warning sign that demands attention. As if the market valuation concerns weren't troubling enough, Warren Buffett has been keeping an increasingly worried eye on another critical metric, the U.S. debt-to-GDP ratio. This crucial indicator, which measures how much debt the government owes compared to everything the country produces in a year, has reached a level that's setting off alarm bells in Omaha. Currently sitting at around 120%, this ratio tells us something deeply concerning. America now owes more than it produces in an entire year of economic activity. But the real story isn't just in the numbers, it's in the domino effect this massive debt load could trigger throughout the entire economy. As the government's debt burden grows, it creates a complex web of financial pressures that ripple through every corner of the market. First, there's the immediate impact of higher borrowing costs. As the debt pile grows, the government needs to offer higher interest rates to attract buyers for its bonds. These higher rates don't just affect government spending. They create a ripple effect that touches everything from corporate profits to consumer spending. We're seeing this historic debt level at the exact same moment that market valuations are hitting all-time highs, and interest rates are at their highest point in years. It's like watching three separate pressure cookers, all reaching their limits simultaneously. When debt levels are this high, even small changes in interest rates can have massive impacts on government spending and economic stability. Each percentage point increase in rates adds hundreds of billions to the government's annual interest payments, money that has to come from somewhere, whether through higher taxes, reduced spending, or even more borrowing. This debt situation helps explain why Buffett isn't just trimming his portfolio, he's making fundamental shifts in how he positions Berkshire's assets. He understands that high government debt levels can lead to various challenging economic scenarios. By building up his cash reserves and reducing exposure to certain sectors, Buffett appears to be preparing for any and all of these possibilities. The current interest rate environment adds another layer of complexity to Buffett's warning, and it's one that has him particularly concerned. We're now seeing rates at their highest levels in years, creating a fundamentally different market landscape than what we've experienced over the past decade. The impact on corporations is already becoming visible, and it's starting to paint a concerning picture. Companies that have grown accustomed to cheap borrowing are now facing a harsh new reality. Higher interest rates means they're paying more to service their debt, which directly cuts into their profit margins. But it goes beyond just higher borrowing costs. Many companies have built their entire business models around the assumption of low interest rates, using cheap debt to fund stock buybacks, finance expansions, or even maintain regular operations. As these companies face the need to refinance their debt at higher rates, we're likely to see significant pressure on their bottom lines and, ultimately, their stock prices. To truly understand why Buffett's current moves are sending such strong warning signals, we need to look back at his track record during previous market-turning events. Throughout his 6-decade investing career, Buffett has made similarly defensive moves only a handful of times, and each instance preceded a significant market correction. The pattern is clear. When Buffett goes defensive, something big usually follows. Let's travel back to the late 1990s during the height of the dot-com bubble. While most investors were caught up in the tech stock frenzy, Buffett faced intense criticism for refusing to participate in the new economy stocks. Instead, he steadily built up his cash reserves and stuck to his value investing principles. Many claimed he had lost his touch and didn't understand the new paradigm. But when the bubble burst in 2000, Buffett's patience was vindicated. While tech-heavy portfolios were devastated, Berkshire's conservative positioning allowed it to weather the storm and even capitalize on the opportunities that emerged from the wreckage. The lesson was clear. Sometimes the best investment move is deciding not to play. The 2008 financial crisis provides another telling example of Buffett's crisis preparation and response. Leading up to the crisis, Berkshire had accumulated a $44 billion cash reserve, a figure that seemed excessive to many at the time. But when the financial system began to crumble, this cash pile transformed from a drag on returns into a powerful weapon. While others were forced to sell at fire sale prices, Buffett was able to strike legendary deals, including a $5 billion investment in Goldman Sachs and a similar stake in Bank of America. These moves not only generated billions in profits for Berkshire, but also helped stabilize the financial system during a critical period. Fast forward to the 2020 pandemic crisis, and we saw yet another masterclass in crisis management from Buffett. While many investors panic bought during the initial market recovery, Buffett remained notably cautious. He maintained significant cash reserves and waited for clarity before making any major moves. This patience, which seemed overly conservative at the time, now looks prescient as we face growing economic uncertainties. Buffett's current positioning is that it's even more defensive than during any of those previous crisis periods. His cash reserves are substantially larger, his selling activity is more pronounced, and his warnings are more explicit than we've seen before. When someone with Buffett's track record of spotting market turning points takes such dramatic defensive actions, it would be wise to at least understand his reasoning. What do you think of Buffett's warning? Are you adjusting your investment strategy in response? Let me know in the comments below. And don't forget to subscribe to the channel for more market insights and analysis.